Transitioning back to the U.S. economy and the sticky inflation theme, this is something we've been talking about for years as well. The key takeaway of the sticky inflation theme is that while immaculate disinflation is on and good, and we're going to take advantage of it as investors, we ultimately believe that the terminal destination for inflation readings in the U.S. economy, in the absence of a recession, are going to be too high. We're going to bottom at a level that is inconsistent with 2% inflation. And unless the Fed is going to change its inflation target, that's going to be a problem. But we don't necessarily believe it's going to be a problem today. So in this chart, we show that inflation is the most lagging indicator of the business cycle. And how do we arrive at that conclusion? We look at this through the lens of our Hope plus I framework. So each of these plots here, or each of these cycles here, are represented by a basket of indicators. And then each of the plots show us the delta adjusted z-score of the basket of indicators in months before or after a recession starts. So, and what we just mean by delta adjusted, we have to invert things like jobless claims and the unemployment rate. So it's all, so good is good, and so up is good and down is bad. So we know the housing cycle tends to break down 16, 18 months before a recession. We know the order cycle tends to break down 8 to 10 months ahead of a recession. We know the production and profit cycles tend to break down 4 to 6 months ahead of recession. We know the employment cycle tends to break down right when the recession starts. But inflation, the most lagging indicator of the business cycle, tends to break down, 6 to 8 months after recession. So one, we know immaculate disinflation is immaculate because it tends not to happen. This is the history of the U.S. economy. It's the most lagging indicator of the business cycle.